I'm a wealth manager by trade, and I am spilling one of the most interesting secrets of the rich. Have you ever wondered how investors make money, even when the stock market is falling? There's a strategy in play here, and it's called shorting the stock market. If you find this information useful, please like, share, and subscribe. Shorting is like borrowing your friend's sweater because you think it's going to go out of fashion, then returning it back to them when it's worth less. But instead of sweaters, we're dealing with stocks. Imagine this. You borrow a stock from a broker and sell it immediately at its current high price. Now, you're sitting on some cash, but you owe one stock to your broker. So you wait for the stock price to fall, then buy the stock back at a lower price, return the borrowed stock to your broker, and pocket the difference. Voila! You've just made a profit from a falling stock. Of course, this isn't some magical money-making scheme. It requires a keen understanding of market trends and a lot of patience. You need to know when to sell high and when to buy low. This is a strategy often employed by seasoned investors who have their fingers on the pulse of the market. But here's the catch. This strategy isn't just about making profits during a market downturn. It's about balancing risk and reward. Because, while the potential for profit is quite tantalizing, the risk of loss is equally real. In a nutshell, shorting the stock market is a bit like surfing. You ride the waves of the market, making the most of the highs and the lows. But just like with surfing, timing is everything. Catch the wave too late or too early, and you might be wiped out. It might seem like a lucrative opportunity, but it's not without its risks. Stick around, because in the next scene, we'll be delving deeper into the process of shorting and unraveling the potential risks and rewards that come with it. Now, you might be curious about how exactly does one short a stock? Well, let's break it down into 4 simple steps. First, you'll need to open a margin account with a broker. This isn't your everyday savings account. It's a special type of account that allows you to borrow stocks from your broker. Think of it as your gateway to the world of short selling. Now that you've got your margin account, it's time for step 2, borrowing the shares. You ask your broker to lend you a certain number of shares of the stock you're betting against. Remember, you're not buying these shares, you're just borrowing them for a while. Once you've borrowed the shares, you swiftly move on to step 3, selling them. You promptly sell the borrowed shares at the current market price. The cash from this sale gets deposited into your margin account. At this stage, your fingers might be crossed, hoping for the stock price to take a nosedive. Finally, we reach step 4, repurchasing the shares. This is when you buy back the same number of shares you initially borrowed. Ideally, you'll want to do this when the stock price has fallen. If things go according to plan, you buy them back for less than you sold them for, pocketing the difference. Throughout this process, your broker plays a pivotal role. They're the ones lending you the shares, facilitating the sale, and eventually helping you repurchase them. It's essential to have a reliable broker who can navigate these choppy financial waters with you. Sounds simple enough, right? But remember, the devil is in the details. So, how does one make money from shorting? Now that's the million-dollar question, isn't it? Let's simplify it. When you short a stock, you're betting on the price of that stock to drop. You borrow shares of the stock and sell them immediately at their current price. Now the trick is to buy those shares back when the price has dropped, return them to the lender, and pocket the difference. Imagine this scenario. You short a stock that's currently trading at $100 per share. You borrow 10 shares and sell them immediately, putting $1,000 in your pocket. Now if the stock price drops to $50 per share, you can buy those 10 shares back for $500. Return the shares to the lender, and voila, you've made a cool $500 profit. But here's where it gets really interesting. The potential for profit is theoretically unlimited if the stock price drops to 0. Let's say you've shorted a stock trading at $20 per share. If that stock price drops to $1, you've made a $19 profit per share. But if that stock price drops all the way to 0, you've made a full $20 per share. Multiply that by the number of shares you've shorted, and you can see how the profits can add up. Of course, this is all theoretical. The market is unpredictable, and there's always a risk that the stock price could go up instead of down. But the possibility of making money from falling prices is a tantalizing prospect, isn't it? It's like being able to predict a storm, then selling umbrellas just before the first raindrop falls. And when the sun comes out again, you buy back all those umbrellas at a fraction of the price, making a tidy profit in the process. Making money from falling prices, it's an intriguing concept, isn't it? And that's the allure of shorting the market. It's a high-risk, high-reward strategy that can yield substantial profits if played right. But remember, with every investment strategy, it's essential to do your homework and understand the risks involved. But what happens when things don't go as planned? Shorting might seem like a lucrative strategy when the stocks are plummeting, but it's not without its perils. The first risk that short sellers face is the potential for limitless losses. Now, this might sound terrifying, and rightly so. When you purchase a stock the conventional way, your loss is capped at the amount you invested. But with shorting, if the stock price increases instead of falling, you could end up losing more than your initial investment. Imagine shorting a stock at $20, expecting it to fall, but it shoots up to $100 instead. You would have to buy the stock at the new higher price to cover your position, leading to a colossal loss. Now, let's talk about another risk that short sellers often face: the short squeeze. This happens when a large number of short sellers try to cover their positions simultaneously, driving the stock price even higher. The more the price rises, the more short sellers scramble to cover their positions to limit their losses, which further fuels the price surge. It's like a snowball rolling down a hill, growing larger and faster with each passing second. Remember the GameStop saga? That's a classic example of a short squeeze. And let's not forget, short selling is not just about predicting market trends. It also involves managing your emotions. The fear of unlimited losses can lead to panic selling, causing you to exit your position at a loss, even when the stock price might eventually fall. So, before you decide to short a stock, ask yourself if you're ready to navigate these risks. Are you prepared to face potentially limitless losses? Can you handle the stress of a short squeeze? Remember, short selling isn't for everyone. It requires a deep understanding of market trends, a solid risk management strategy, and nerves of steel. As with any investment, there's no reward without risk. So, what have we learned about shorting the market? It's crucial to consider your financial situation and risk tolerance before diving into the deep end. Shorting the market isn't for everyone. It requires a keen understanding of market trends, careful analysis, and a stomach for risk. It's not something to jump into without due diligence. Moreover, it's important to remember that the stock market isn't a get-rich-quick scheme. It's a tool for wealth creation. And like any tool, it must be used wisely. It's essential to do your own research, to understand the companies you are investing in. Make informed decisions based on your own analysis, not just on market speculation or the latest buzz. The stock market, like any market, is a reflection of the economy. It's a barometer of business activity, consumer confidence, and economic health. So understanding the market, the economy, and the companies you invest in are key to successful investing, whether you're going long or short. Remember, the stock market is not a casino. It's a tool for wealth creation, and like any tool, it must be used wisely. It's Wealth Redux, spilling the secrets of the rich. If you like this information, please like, share, and subscribe today.